Hi, my name's Nick Griffin. I'm the CIO here at Munro Partners, and today we're here to talk to you about the Munro Concentrated Global Growth Fund. So at Munro Partners, we run three funds. Most people know us for the Munro Global Growth Fund. That's actually our absolute return global growth fund. The fund we're going to be talking about today is the Munro Concentrated Global Growth Fund, which is our long-only global growth fund. And we also run the Munro Climate Leaders Fund. All three of our funds are designed to fit the growth hole in your portfolio. We want to be global equities and we want to be growth. And today we're talking about the long-only version, which is suitable for clients on a longer time horizon and is definitely more volatile than our flagship product. So our philosophy here at Munro Partners is fairly simple. We think that earnings growth drives stock prices. We generally find that companies that make more money every year, we generally find their share prices go up. Secondly, we think sustained earnings growth is worth more than cyclical earnings growth, and the market often misprices growth and its sustainability. So what we're showing you here is two companies. The first one on the right-hand side is Bank of America, and the second one on the left is MasterCard. The light grey line is the blended forward earnings per share for these companies, and the black line is their share prices, pretty much over the last 15 years. And what you can see quite clearly is share prices follow earnings. Companies follow the earnings profile that they can produce. Secondly, we'd point out that Bank of America is a macroeconomic company. Its earnings are going up or down with the economy. And what we'd say at Munro Partners is we don't actually have a lot of value to add on this. We have a view on what the economy is going to do, but we don't have an edge. Our view is as good as other fund managers out there. On the left-hand side, you have MasterCard. MasterCard is benefiting from the shift from physical cash to digital cash. So it's a structural grower. Its earnings have grown structurally over the last 15 years, and its share price has followed its structural earnings growth. And this is what we're talking about. The funny thing about MasterCard is everyone's known this for the last 10 years, yet the market can't actually price it in. And so that's the key point, the last point. The market will often misprice growth and its sustainability. And so at Munro Partners, what we're trying to do with this fund and all our products is we're trying to identify the MasterCard situation over and over again. And the reason why we do this, and the reason why we think this works, is because we think it's all that really matters. We would argue that if you go back over time and look at equity markets, it's not about going over or underweight sectors or over or underweight countries. Equity markets are actually made up of just a handful of exceptional companies and thousands of mediocre ones. On this chart, we're just showing you an analysis done by a guy called Henrik Bessenbinder, who points out that if you looked at every company that ever listed over the last 90 years, it's actually 25,300 companies. Yet only 4% of them make up the entire wealth of the US stock market over that time horizon. And if you look at just the top 50 of that 4%, that's 50 companies out of 25,000, they make up nearly 50% of the entire wealth of the US stock market over that time horizon. So equity investing is unashamedly a game of few winners and lots of losers. On this slide on the right-hand side, we're showing you those top 50 companies. And if you look at those top 50 companies over time, macroeconomics has very little to do with it. The reality is if you look at their life along the bottom and their annualized returns across the top, on the left there, it is always the big structural changes that create these companies. Whether that's digitalization that created Google, Facebook and Amazon, whether that's software that created Microsoft and Oracle, or even if you go further back, you can see big box retailing and Home Depot and Walmart, McDonald's and quick service restaurant, and Disney and entertainment. So from our point of view, it's fairly simple. Equity investing is not about identifying the economy, it's about identifying the big structural changes that are about to occur and then identifying the winners. And so at Munro Partners, our job is really to occupy the top left-hand corner of this slide and to really try and work out what's coming next. And so how we do this is by really just bringing our universe down to a very small universe of structurally growing companies. And so put simply, as we're showing you on this slide, we think there's literally over 35,000 companies in the world that are listed. And we have no hope of covering them all. There's a whole bunch that profess to grow, but they're always growing because of those macroeconomic reasons, whether it's GDP going up or down or interest rates going up or down. But what we're interested in is these structurally growing equities, this smaller universe. We've got this down to 1,000 stocks, and we split it into these different areas of interest. So climate change or high performance computing or e-commerce, these are good places to look for those structurally growing areas. These are good structural tailwinds in the economy today, and so clearly a good place to look for a structurally growing company. And what we're looking for are the companies that are going to execute best on these opportunities. How we do that is to really go back and look at what we've learned over the years as to what are the great qualities of a great growth company. So we've got our 1,000 universe, we've got our 20 different areas of interest. We now want to focus on the areas of interest we're looking for, and then we want to focus on the company that we think is going to do it best. From our point of view, there are 6 characteristics of a great growth company. The first is that it can actually grow. Usually revenue growth double GDP is what we're looking for. The second thing we're looking for is the ability to leverage that revenue growth. The third is that revenue growth is sustainable or it has a long runway in front of it. Fourth, they've usually got good ESG characteristics. Fifth, they've normally got controlling shareholders or highly aligned management. And sixth, they've usually got great customer perception. If you go back over time, these 6 rules work very well for identifying great growth companies. Amazon had them, eBay didn't. Apple had them, Nokia and BlackBerry didn't. Even here in Australia, Macquarie Bank has them, National Australia Bank doesn't. These are the characteristics that you need to be a great growth company. From that point of view, does that mean it's a good investment? Maybe not. Valuation is important. On the right-hand side, what we're asking the team to do is build an earnings model. That earnings model, bottom up, proves that the earnings of this company can double over the next 5 years. And that earnings model needs to mathematically prove that we can get the share price to double within 5 years. That's essentially what we're looking for. And so every area we're looking at, we're looking for the structurally growing area, for the company we think can best execute on that, and thirdly, for the one where the maths adds up to give us a double on the share price within the next 5 years. And those are the companies that make it into the Munro Concentrated Global Growth Fund. The last part of our process is clearly, as I showed you on the first slide, if it's a game of very few winners and lots of losers, then we're clearly going to make mistakes. And risk management is incredibly important to what we do here at Munro. This slide is just simply showing you some of the rules that we put in place to keep our risk management in place. And so the first thing is we run 20 to 40 positions, so we do run a diversified portfolio. Secondly, we have maximum position sizes of roughly 10% and some restrictions around the sectors we can invest in. But thirdly, and most importantly, we run formalised stop losses. Any company in the portfolio that falls 20% from cost or 20% from peak is subject to a review. That review is designed not to force us to sell the company straight away, but merely to say, is the price telling us something that we might have missed? Should we review the investment case? And what we'll often do is we'll review the investment case and we might often decide to keep the company. But in 30 days' time, if it's still triggering, we'll have to review it again. And in 30 days' time, if it's still triggering, we will review it again. And inevitably what happens here is you work out that you've made a mistake. BlackBerry's not the smartphone winner, it's Apple. And so you end up selling your BlackBerry and you buy Apple. Or eBay's not your e-commerce winner, it's Amazon. And so from that point of view, what we're trying to do here is really minimise our mistakes, but also most importantly, lead us towards those few big winners. And you can see this in action with the picture on the right. On the right-hand side, we're showing you our top 10 winners since inception for the Munro Global Growth Fund. And on the left-hand side, you're seeing your top 10 losers. And this is the simple maths that you need to think about in basis points contribution for your fund. Your winners should far outweigh your losers, i.e. you should find your winners and run them for long periods of time because they are these exceptional growth companies, and you should eradicate your losers quickly. And this will ultimately lead you to the double-digit returns that we're looking for from this product. The last part of our process is really summed up on this last slide. So at the end of the day, what you're looking for is a range of different structural growth drivers, all of them with different idiosyncratic structural drivers. And those idiosyncratic structural drivers should lead you towards the companies that can grow their earnings as well. And that earnings growth should lead to share price growth. What we're showing you here is the fund as it was positioned at the end of September 2022. And you can see there that innovative health is the biggest area in the fund. So these are healthcare companies that we think can grow regardless of the cycle. They make up roughly 16% of the fund. There's 5 companies there, and Danaher in bioprocessing is the biggest position there. Second biggest area we like is climate at this point in time. We think the decarbonisation of the planet is going to accelerate. Here again, we've got 16% of the fund. There's 5 holdings there, and the biggest position there is Next Area Energy in the US. Below that, we have digital enterprise, which is cloud computing. Below that, emerging consumer, of which we like Costco and a number of other names. Below that, digital payments, which was the MasterCard idea I gave you earlier. And lastly, high performance computing, which is high-end semiconductors. These are the areas where we see strong structural tailwinds. Those tailwinds which should ultimately equal strong structural earnings growth for the companies that have best positioned themselves, and that earnings growth should ultimately lead you to strong structural share price growth and lead you towards the double-digit returns we're looking for. So that, in short, is how we run the Munro Concentrated Global Growth Fund. Lastly, on this last slide, we just please point you towards our website and our materials. for any more information you need to deal with your personal situation. But also on the website are a bunch of videos that go into much more detail about some of those areas I talked about and why we think they're such great investment opportunities for the future. Thanks very much for listening.